India's GDP is booming at 7%, but your personal finances are silently crashing. One medical emergency in 2026 could destroy you because medical inflation is hitting 11% and insurance won't save you. 62% of these medical bills are still paid out of pocket. With AI resetting jobs, your old savings advice is outdated. You need a financial firewall. Here is the Golden Shield strategy to protect your wealth.
Welcome back to Paisa Forever channel. If you're watching this in 2026, you are living through one of the most paradoxical economic moments in Indian history. On one hand, the Sensex is flirting with new highs and our GDP is clocking a robust 7.3% growth. But on the other hand, you might be feeling a strange sense of fragility in your personal finances. You are not alone. Today, we are going to talk about the single most unsexy yet critical component of your portfolio, the emergency fund. But we are not going to give you the outdated advice of save 6 months of expenses and put it in a savings account. That advice is dead. The financial landscape of 2026 demands a sophisticated, multi-layered liquidity architecture. We are going to break down the exact math, the tax implications under the new regime, and the behavioral psychology of why you need a financial shock absorber right now. Let's start with the macro picture. Why is liquidity your absolute priority in 2026? Economists are calling the current Indian economy a sedan stuck in a traffic jam. The vehicle itself, our domestic consumption and manufacturing, is powerful and sturdy. But we are stuck in global traffic. While our domestic growth is strong, we are increasingly vulnerable to what experts call Red Riding Hood moments. These are global shocks that come out of nowhere. We are seeing unpredictable trade tariffs from the US and shifting geopolitical alliances that ripple through our export sectors. What this means for you is that while the country grows, your specific sector could face sudden headwinds. Income stability is no longer guaranteed by national GDP growth. You need a personal firewall. This brings us to the first actionable step, the 3-6-12 rule. For years, financial planners lazily suggested a 6-month buffer for everyone. That is inefficient capital allocation. In 2026, you need to personalize this based on your risk profile. If you're in a dual-income household working in a stable sector like PSU banking or government services, a 3-month expense buffer is sufficient. You don't need to drag down your net worth by hoarding cash. However, if you're a single-income family with dependents or you work in a cyclic sector like retail or real estate, you must target 6 months. This accounts for the time it takes to find a new role at a similar pay scale in the current job market. Now, if you're a freelancer, a business owner, or, and this is crucial, working in a high-risk startup, you need a 12-month runway. The data shows that hiring cycles for executive roles in the private sector have lengthened significantly this year. You cannot afford to accept a lower salary out of desperation just because your emergency fund ran dry in month 4. Let's move to a risk that's eating into savings faster than anything else: medical inflation. Aon's latest report for 2026 pegs medical trend rates in India at 11.5%. That's nearly double the general retail inflation. You might say, but I have health insurance. Here's the reality check. Insurance is not a catch-all solution. Currently, 62% of healthcare expenses in India are still paid out of pocket. Insurers have become stricter with consumables, the gloves, PPE kits, and administrative charges that policies often exclude. Furthermore, many Tier 1 hospitals demand a significant cash deposit before admission, regardless of your cashless insurance status. If you don't have liquid cash to cover that immediate 1 to 2 lakh rupee deposit, your insurance card is just a piece of plastic. Your emergency fund acts as the bridge between the medical emergency and the insurance claim settlement timeline. Now we have to address the elephant in the room: artificial intelligence and income interruption. The narrative that AI will steal all jobs is an exaggeration, but the structural shift is real. We are seeing major IT and service-based firms shifting to AI productivity workflows. This doesn't always mean mass layoffs, but it does mean headcount resets. Companies are freezing hiring for 6 to 9 months while they restructure. If you're a skilled professional, you might face a period of income interruption where you need to upskill to remain relevant. This isn't just about survival, it's about having the capital to pay for a certification or a course while you're between jobs, without dipping into your retirement corpus. So, where do you keep this money? You shouldn't leave it idling in a savings account earning 3%. You need the 30-30-40 strategy. This strategy balances instant access with inflation-beating returns. First, keep 30% of your emergency corpus in a sweep-in fixed deposit. This is linked to your savings account. If you swipe your debit card or write a check for more than your balance, the bank automatically breaks the FD to cover it. This is your T+0 liquidity, immediate access. Next, put another 30% in standard short-term FDs. These lock in interest rates, which as of late 2025 have hovered around 7% but are softening as the repo rate has been cut to 5.25%. These funds are accessible within minutes via net banking but provide a stable yield anchor. The remaining 40% should go into liquid mutual funds. These funds invest in very short-term government securities and commercial papers. They offer returns that generally beat savings accounts and compete with FDs, but with better taxation efficiency if managed correctly. This brings us to a massive opportunity for 2026, the Section 87A rebate. Under the new tax regime, which is now the default for most of us, income up to 12 lakh rupees is effectively tax-free once you account for the standard deduction and the rebate. Here's the hack. If your taxable salary is say 9 lakh rupees and you earn 50,000 rupees in short-term capital gains from your liquid funds, that gain is added to your income. Since your total is still under the threshold, you pay zero tax on those gains. This makes liquid funds highly efficient for middle-income earners compared to the 30% flat tax bracket for high earners. You need to leverage this tax arbitrage to protect your emergency fund's real value. Now let's talk about execution. Willpower is a terrible financial strategy. You need automation. We are seeing a rise in neobanks like Fi and Jupiter that offer features like digital pots or jars. These allow you to set up FIT rules. For example, every time you receive your salary, the app automatically moves 10% into a designated emergency pot. This separation is vital. If the money sits in your main spending account, you will spend it. By digitally siloing these funds, you remove the temptation to use your safety net for a vacation or a new phone. But what if the worst happens? What if you burn through your cash? You need to know about your final safety valve: gold loans. With gold prices hitting record highs in 2025 and 2026, the equity in your household jewelry is massive. The RBI currently permits a loan-to-value ratio of up to 75%, and some specific schemes push this efficiency even higher effectively. The beauty of a gold loan is speed. You can walk into a branch and walk out with funds in under 60 minutes. It's much faster than a personal loan and cheaper than a credit card rollover. Treat your gold not just as tradition, but as a dormant asset class that provides high-speed liquidity. Before we wrap up, I want to address the psychological aspect. We often treat finance as pure math, but it is deeply emotional. Recent 2026 studies on financial stress show that young adults facing financial uncertainty are at a six-fold higher risk of clinical distress and anxiety. An emergency fund is not just a financial buffer, it is a behavioral shock absorber. Knowing you have 6 months of runway allows you to negotiate better at work, say no to toxic projects, and sleep better at night. That psychological resilience is priceless. Finally, you must be aware of your secondary liquidity valves, specifically your NPS and PPF. Many investors lock money into the National Pension System, NPS, thinking it's gone until age 60. But under the current rules, you can withdraw up to 25% of your own contributions, not the employer's, after just 3 years for specific emergencies like critical illness or skill development. Similarly, your Public Provident Fund, PPF, allows for loans from the third financial year. These are not your primary emergency funds, but knowing they exist prevents you from panic selling your equity portfolio during a market crash. Now, I need to bust 3 dangerous myths that I hear constantly in the comments section. Myth number 1. My family is my emergency fund. I hear this a lot in India. I don't need cash, I can borrow from my parents or my brother. The data shows 19% of Indians rely on this social network. But here's the harsh reality. By doing this, you are transferring your financial stress onto your loved ones, potentially derailing their retirement goals. It places a strain on relationships that money often cannot fix. Be your own bank. Myth number 2. I have health insurance, so I don't need a cash buffer. We touched on this, but it bears repeating. 23% of hospital bills in India are currently funded through distress borrowing at high interest rates because people assume insurance covers everything. It does not. The deductibles, the co-pays, and the non-medical expenses can wreck your finances if you're not prepared. Myth number 3. I should invest my emergency fund in stocks for better growth. This is the most dangerous myth of 2026. The market is volatile. Small cap stocks face high earnings downgrade risks this year. Imagine losing your job during a recession which causes the market to crash by 30%. If your emergency fund is in stocks, you are forced to sell at the bottom, turning a paper loss into a permanent destruction of capital. Your emergency fund has one job: protection. It is not an investment, it is insurance. Do not chase alpha with your safety net. So, here is your takeaway for today. The Indian economy of 2026 is full of opportunity, but it is also unforgiving of those who run without a safety belt. Review your liquidity today. Are you following the 3-6-12 rule? Have you split your corpus using the 30-30-40 strategy? And are you relying on insurance alone to save you? Don't wait for the shock to hit. Build your architecture now so that when the world gets volatile, your life stays stable. If you found this breakdown helpful, hit that subscribe button. Stay liquid, stay safe, and I'll see you in the next one.
Disclaimer: this video is for informational purposes only and does not constitute financial advice. The market involves risk, so please conduct your own research before investing.